Good afternoon, welcome. It is December the 21st, 4 days before Christmas. We're going to wrap up on today's action, a 3-day reversal for the major stock markets today that started yesterday. We're joined by Meta Johnny, who's going to talk a little bit later about Bitcoin. That had one heck of a bounce. And Markets for Mayhem, Alex, is here as well. So thank you, guys. We will start off just going through the charts real quick. Up on your screen, you can see the S&P today, a nice steady rise from yesterday. Remember that positive divergence yesterday, almost at 08s, and we just continued up through the aftermarket. Fundamentally, the major driver was Micron coming with an outside surprise. That company had missed earnings for quite a while. That drove everything up. And through the day, it was just steady Eddie. And you can see we got into the, as far as Ichimoku goes, got into the cloud. We came and tested the bottom of it. And we rallied up through that in a perfect 1, 2, 3, 4, 2, 4. So a perfect unison there. If we look at daily, a big close actually, we were watching this all day, remember, Alex? On the daily here, we managed to close just above that tank, and that's significant. I do sound a little bit obsessive with that. That's just basically because that tells me where the market is, when it coincides with these Murray math levels. And actually, the price is ahead of the Chico here, which is actually telling us that it's not overbought, believe it or not, with this run.
Right.
So you don't see that very often in the SPOOs, and there's a reason for that. This one will go through that in a sec. So remember, you're bullish, 1, 2, 3 higher. It's your 1, 2, 3, right? You're bearish. This is going to be your second wave, and we're just doing what series of 1, 2s. With this kind of energy, I find that would be unlikely given we are coming into Christmas. On the 1 minute, it's probably more pronounced there what went on today. So here's the 5 minute. I did say 1 minute, but here's the 5 minute. And you see it was a perfect buy off down here at -2.8. So it was after the retail selling and a bit of the bear, we've failed, let's hit it. And then we failed and we rallied up all day. We got through here without a worry. And then sideways up here into the cloud, and then we took off again. But see what's running this. It's a 50 moving average of different degrees. This is a 5 minute chart. So you need to put all those together, and then you get to feel it. Now, what's significant here, this little break here that then broke and failed and went, Apple was, it was up. It took all this about to here before the Apple itself actually got up. And here's when it had its little run, like a $2 run. It stalled, the market came off. Significantly, it was able to do this with Apple just staying at that level. So that's healthy. You don't want a market relying on one thing. And here is Apple looking at that.
Yeah.
You can see what Apple did here, right? So this is a 240. And this is what the target is on Apple if we can keep going. We're a little bit under the high in aftermarket here last time I looked, as far as Apple goes. And if we look at the 60, so there we go. So nice, steady. We filled that gap. Then we got a sell off, and then we got this bounce again. So while that was selling off, that was where we saw SPOOs going up. And then finally, we saw that pop right at the end on SPOOs, and this just held it. So that's our S&P and Apple. Any thoughts on any of that before we go on the next two, Alex and Johnny?
Yeah, so, Apple's been a kind of barometer for market sentiment in some ways. And as you noted earlier today, wasn't necessarily pulling the market higher. And then later in the day, it kind of came and started participating with it. And we had some other leaders kind of stepping in and really pulling higher. Facebook was a leader today. Tesla was a leader today. Microsoft, Nvidia. So some familiar names kind of stepping into for the initial pull higher in the Nasdaq. And then as we got later in the day and started breaking a new daily highs in the Nasdaq, we saw Apple really get dragged higher with that. I think about like $4 or $5 off the low. So that was pretty impressive. But it's definitely an interesting one to watch. Nevertheless, it's got the apple of my eye, so to speak.
Yeah, I mean that was something I did notice. I was impressed with, and so basically new leaders started the thing today, which was Nike and Micron with their earnings, and we did reclaim that 50 DMA on the Spurs. On the cash, which is 46.14. So we did reclaim that, and then we got strength from that. So the big thing that stood out for us today was this little thing. This had just been whacked and whacked and whacked. And yesterday we made a point about this pink line or the mauve line being, I think, for basically the whole year. If I just put that on daily real quick. So on daily, the Russell had been on this line or the support line since last year. So this is December last year. So this is a whole year. And this is where we were. So obviously a lot of this we've commented about was tax selling, overbought, fear of interest rates, etc., etc. Remember, interest rates have barely moved. Banks are lending as least as what they were before. That's the other thing. Banks really haven't been lending like they should be. So a lot of this was overdone. The smart guys in here did secondaries, etc., and they're good to go. And that'll show out here if the economy picks up. So the quality will pick up in this index. So look within that index if you're doing your stock picks. There will be some quality that's beaten down. And my guess is some of that's what went on today. So if we look at that on 5 minutes, maybe that's too short. Let's look at a 30-minute. And there you go. So pretty well, ever since that's the same, remember that same buy yesterday from S&P and Nasdaq? This is where it got outsized today. It just took off. And, I mean, there's a little pullback here, but it was just to the tanking, so it was orderly. And this is a 30-minute chart. That's a good period I look at Nasdaq and Russell because it smooths out. Anything shorter than that, those indexes are thinner. They got a more speculative crowd. So that's the idea of that. But look at that. That's a heck of a move, right? So that move was actually, in percentage terms, was 3% today. So that was a big move. I'll just give you I think it was 3.6.
It's interesting too because when the Russell was sold off yesterday overnight and then during the cash session, it was the weakest performer. But when it began to turn around midday, it had the greatest performance off its lows versus any other index. And then we're seeing that outperformance today. So I thought that was noteworthy as well.
Yeah, definitely. I mean, and that's a combination, I think, of, like I said, someone's trash. It's another person's diamond, right? They find a jewel in the rough. So I think there's a bit of that. There's some stocks that we all like for different reasons, growth potential, asset backing, etc. Your traditional things. And some of those are really beaten down. And Johnny here made a good point on not a Russell stock, but AMD and a few other tech stocks had really been oversold as well. So we saw action in that, which also helped. The Nasdaq also performed well, but just not as over the top, for want of a better word, as Russell. So that was very healthy if you're a small investor. What we don't want to see, though, it was a one shot, right? That's not what we'd want to see in that situation. But Nasdaq, similar. That was up 2.4%, so a percentage less, but that's a bigger. So nevertheless, that was the second biggest today. And actually, the Dow was the low. It was up, but remember the Dow a week ago was a darling. Look at this. Similar pattern down here. It actually almost identical except for this. So what was interesting, this was the weakest at one point versus the S&P and definitely versus the Russell. because they often go together. Look at that. So it had to catch all this ground up, whereas the Russell we just saw, it basically came right from there. Now, the other big one for mine today was oil. Oil had a huge run yesterday. It was down 4, then was up 2, and it was up another 4% today. So another big move. Let's look at that on the daily. That's what we've been looking at, right? So if you're used to, as I said this morning, Keltner bands and Bollinger bands, it's the same type of thing you're looking for when you get this pattern. You won't see this very often in Ichimoku, but it's the same thing you're looking for. It's compression, and then it breaks. But then we had this massive false break yesterday, right? Oil's the best example of this out of all the stock markets. So, and after hours, we had just let me run through that. I got that here, the API number was also bullish. So we're seeing it a little bit higher in the aftermarket. There was a $3.6 million draw. Gasoline, however, was a 3.7 million build. But given that last week was the biggest gasoline usage since the pandemic, actually this Monday, not last week, that's probably going to be ignored. And distillate was lower. The bearish thing was Cushing was another 1.2 billion. Remember the WTI contract you probably all trade unless you're English. You're going to be trading the Brent. That is the hub for it. API, most of us who trade oil don't pay much attention to it, but it can move markets. The Cushing should be similar though, however. So that's that. That's just out, and you'll see that action. Here's the 5-minute. See Cushing basically did nothing right after hours. See that, guys? I mean, the API with the Cushing, you see it's slightly down. But this was a beautiful trend all day. We hit S2 yesterday, and we've just rallied. Today we opened it just above the pivot, and we've just climbed all day. Right to the Tenkan, just followed it. See pretty well all the way, right? Nice, just simple move. That's 5-minute. You can see on your grid it traded perfectly. You never actually got stopped out on any pullback, which you don't see too often, right? Not in that little thing.
Yeah, that's true.
Oil can be pretty brutal, but it's not for the faint of heart. So we got a lot of noise going on there. Energy. So the Dutch futures, I believe, hit an all-time high this morning for natural gas. That is,
wow.
Yeah, so that does affect the psychological, if anything. But you do use heating oil to heat. So look at this on the hourly. Just constant since yesterday. That was the dump.
Yeah, that's a pretty big move.
Yeah, that's 65 to 72. So that's $7.
Right.
In percentage terms, it's almost 10%. And if we look at natty gas, which chart have I got here? 60 minutes chart. It's actually, as I mentioned this morning, it's actually been up twice in a row. That's an effort for this lately. It's in a very tight grid, as you can see. That's not even 2 Murray math moves. We have done a little false break here, so there could be some people short here. Probably not. This is all to do with weather. And the main reason is to remember this. If you recall when it went to 650, it was like all these novices that aren't from the energy world, let alone the natural gas world, jumping in. It's going to go to 10 or 12, energy shortage around the world. This is a domestic domestic commodity. For example, WTI is also West Texas Intermediate. It's not Brent. It's not LLS or something else like that, right? So you have the difference is with WTI, it's also a speculative vehicle, and so is this. This is Henry Hub, which is basically Sabine, as we've taught many times. This is not Holland. It's not England. It's not China. It's not Australia. So a lot of that big collapse was from simply not getting that. And look at that, bang. So if we were to put an overlay, a Dutch one, Holland is still up here. Well, actually, way above there. But look what it's trying to do here, but there's nothing to hold it up. That's the trouble. It needs a little bit of time to build that energy. But weather and natty, It's when you're playing with fire, even when you know it, it can be really difficult. So that's all that. Before we jump on to other things, Johnny's going to tell us a little bit about Bitcoin. So Bitcoin did identically the same thing. It got bought with risk today. What's your thoughts on that, Johnny? 45 to 49. That's like $4,000 move.
Well, many of the people, because of the market, the overall market, including the equities markets, the Bitcoin, or if you will, the altcoins and the other markets, which are decentralized, centralized crypto markets, they react very similar. They get bullish when there's a lot of steam going into the equities markets, but there are a lot of things right now that are happening with crypto, with the metaverse, and a lot of different things that people are using and seeing more utility and more opportunity and more investment. Private as well as different institutions are getting into backing or understanding how it really fits into the overall scheme of things, if you will, because the whole, and the way that the banking has mistreated our money, they want to make sure that they have the right infrastructure moving forward and something that they can fall back on, which I think is it's an early adoption, and it's shaking out people right now, and then it's building a base. So they think these pullbacks can be good and healthy.
What I noticed was it actually went up with other assets. Before, it's kind of been in its own world. It actually was a replica. And actually what it mirrored today was the US dollar. They're almost the same. Here's the dollar yen. Look at that pattern. So that's the US dollar going up, and Bitcoin went up with it. So you're right, it's becoming more accepted, I guess, as you said, was the key word there.
Just people aren't as trusting of our legacy banking, and it's now.
This would go hand in hand with this one is to do with interest rates as well, because remember, interest rates were going up all day today across the curve, and actually it was an old school bond trader's technique today. If you want to sell something, you may get attractive enough. So there was a 20-year option, which I rated basically an A. I think some people even had it higher. The main reason of that rating was because it went in with such a high yield that it came out with what they call the tail, the negative tail, meaning that people were attracted to the auction and actually bought it for less than what it went in at the closing price. So so that's significant. So it looks like they're buying it to buy the US Treasury bond for what it is, but it's also because interest rates are so high, and then they bid up for it and actually outbid each other in the simplest terms. So someone asked earlier, how do you grade a bond, right? So first thing's the tail, what I talked about. So that's basically the high yield versus the rate just before it went in. So if it's a negative tail, it means there's demand. Just think, I don't know, in stock terms, how would you think about it? Say Apple's at 173 right before an auction for it, and everyone were willing to pay higher for it. So remember, yields down means price up, bonds price up. People get that a bit mixed. But the other thing, both the direct, which is domestic demand, and indirect, which is international demand, were well above the 6-month average. So that shows you there's demand from both sources. So when you look at international, unless it's coming out of the Caribbean, which would be basically US hedge funds as a general rule, avoiding tax, however you want to put it, that's real positive. And the dealers took less. In other words, there was more buyers, and the bid to cover was well above. So bid meaning how many people are buying versus how many are selling. So what's interesting, on the same day, Bitcoin had a really strong run, bonds had a really strong run, and the US dollar had a really strong run. So I thought that was interesting, Johnny.
Yeah, and people are wondering what's going to happen now that the end of 2021 is coming. So I would recommend that if anybody listening, if they'd like, they should go to the Messari report. The Messari, it's MESSARI, and it's a crypto analytics company that comes out with a crypto thesis of what's to be expected in 2022 and their predictions. And some of the things that are interesting about the gentlemen that have kind of put this whole thing together, it's a group of guys that have been in the crypto business and worked for different exchanges. And one of the guys, his name is Ryan. He put out a tweet, and I'm just going to read this. He says, I'm sick of feeling like we have to apologize for our early stage and walk on eggshells around politicians and regulators. We built a $2 trillion financial market from scratch in less than a decade with absolutely no institutional help and active encumbrance from government. So that's kind of saying something about what's happening with the way people are starting to pull, and some of the predictions. I think that the community that really backs Bitcoin and these altcoins, you have to understand they see something different than a lot of other people. Some people just
right. Well,
they
I
want
did
to
notice today in that they did all go together. I mean, the other thing that's really noticeable today in the Forex world, and I kind of put Bitcoin in that area, it's because it's a currency right now. It's a change. It's a mode of exchange. The Australian dollar was the strength today. Look at that chart there over the last 3 days. While everything was selling off, this little thing has just been powering ahead. And that's significant, A, because commodities, but also risk on. So the risk on means you buy the Aussie dollar because it's pretty well the world's commodity market, right? If there's demand for commodities, which I guess would be energy to make Bitcoin as well. But look, that's significant. If that gets, and obviously they're going to differ, the economy is really strong, trade's con. But it also tells you what's going on with China a little bit too. That isn't, the CCP doesn't exactly tell the truth when it comes to what they're buying. So that's in there. We saw iron ore pop up. Copper's been real volatile lately. That's recovered. Let's go back to that. So yeah, interesting. Thanks for that, Johnny, on all the Bitcoin. And that what? So let's see what else we had today, really. We had the semis run. Actually, another thing, Alex, we noticed Cisco was hitting 52-week highs, which surprised me, really, to be honest.
It's interesting to see the strength of the bid in Cisco from a technical standpoint. I mean, if you're just looking at the price action, it makes a whole lot of sense with the way it's been acting. But from a fundamental standpoint, this one's been a laggard for quite a while. A lot of the other techs have run a lot higher. Its peers like Palo Alto and Fortinet have been, really having quite a strong year, and Cisco's kind of lagged behind them. So a little bit of this is a catch up. A little bit of this is also, I think, the realization that management might not be as quite as inept at this stage of the game as they were earlier, in the sense that, Cisco really had a lot of legacy parts of their company. They hadn't been innovating. They hadn't been spending enough on R&D. A lot of the growth was achieved through M&A. And they're starting to get a little bit more bearings as to how they kind of monetize the ecosystem that they've built and the offerings that they have. So, the good news is, I think for people that are long Cisco, from a technical standpoint, it looks like this move has some room to continue. And this is one of those rare tech stocks that actually makes money. It's not really overvalued. It pays a dividend of 2.43%. So, it makes it a little bit more attractive from a risk reward perspective as well.
That's a good point. It pays a dividend, and again, that's ahead of the yield. So we saw on the same day we saw risk be taken higher. We also saw, I would say, Cisco's not really a risky stock, given that, well, it's risky because it's tech if Nasdaq collapses, obviously. So I'll take that back. But what I mean is, it is a safer stock. It does pay a dividend and the like. So that was interesting. And there was another one we talked about hitting 52-week highs. Who was that? I'm trying to think. But we are seeing a little bit of that. And the other point, I kind of quit, but we're only 90 handles from an all-time high in the S&P. You would have thought it was the end of the world, right?
Yeah, there was a lot of bearishness out there on social media. there were a lot of folks who got really, kind of pessimistic or even like went heavily short into the market at probably the exact opposite time as to when that should be going on, at least in my humble view. I mean, a lot of the sentiment extremes that are on the negative side tend to be better short-term buying opportunities, and a lot of the negative extremes on the positive side, where people are very euphoric, tend to be short-term selling opportunities.
Right.
And so, we've seen, as Madavi likes to call it, and I know he's not here with us today, but the popcorn machine, right? Where you get people kind of coming in and buying tops and selling bottoms and really just getting hurt on both sides. That's been, I think, one of the things that's been going on the last, really over the last month here. So, it's a trader's paradise if you know how to trade this kind of market. I mean, you and I and Madavi and others I talked to have been enjoying it because there's a lot of opportunity. But if you're an investor in this thing, I mean, watch out. It hasn't been a lot of fun for people that are looking at their portfolios up several percent, down several percent, down several percent, up several percent, and then down several percent, down several percent. Like, it's been a lot of kind of one step up, two steps down for a lot of people, unless they're in those mega cap stocks or some of the other sectors that have been outperforming. But this is one of those markets where you look at the Nasdaq and like only 28% of the Nasdaq is above its 200-day moving average. Right. So, even though we've seen a little bit of recovery the last couple of days in some of these names, certainly plenty of room for further upside if there are legs behind this move, if the market breadth improves. On the other side of it, however, if we can't hold these levels that we've been defending, this could be the start of a much deeper move lower, because we're at very critical levels in a lot of these stocks.
Right, I mean, some good points there that a lot of people tend to, fall in love with the stock is the right one, but a lot of people misunderstood because they were new to the market, or they believed in their own genius, I guess, when the QE just pushed everything to ridiculous levels. So a lot of stocks got outside the norm, and this time it was different, etc. And what happened with that was a lot of people didn't take profit, or use the tools to protect profits, things like options, like put options or whatever. And a lot of people just misunderstand the whole game there. You saw a lot of that, and the point you're making is usually the majority of people buy puts at the worst possible time, right? When vol's really high, market's way down low, and we saw that yesterday, and we see that time and time again. Of course, the overall really bearish situation is very bad. We all know it's way overvalued as far as fundamentals go, but it's very hard to perfectly time a collapse. They don't happen very often. So the best way is obviously to trade with the market and stick with the trend as long as you've proven otherwise, right? Which is, I think, what we're preaching. Because you really don't know. But what's really good with having a technical analysis system as a base is it creates discipline. And W.D. Gann, I probably say this way too much, but he said, I can teach 85% of you how to make money. I can teach 100%. But of all those people, there'll be less than 5 to 12% will actually listen to me and keep staying, making money. And that's the key to trading, having a system and being prepared not to be, look at your human frailties, your emotion. And yesterday was a great example of that. I mean, Alex spends a lot more time on social media than I do, so he's a better gauge of it. But he was telling me just how, when everyone should have been shorting a few days ago, yesterday they were all kind of freaking out, right? So, and by today, I guess they're all euphorically bullish, are they?
Not quite yet. We're seeing more kind of jitteriness. There are people claiming, oh, I was long from yesterday's low, and they only post that the day after, and I was short over the weekend into yesterday's. I mean, like, there's a lot of that kind of like Johnny hindsighting going on. But I don't see the overt bullishness coming back yet. I think a lot of these folks, truth be told, probably liquidated their portfolios towards the lows that have happened in the last couple of weeks and are kind of sitting on the sidelines, twiddling their fingers and probably fighting FOMO, or, like you said, I think either on this or earlier when we were talking, potentially just like buying into the days like today. When you see these rips and getting like a lot of kind of, oh gosh, I don't want to miss out on the move. What if this is the bottom? And just, putting it all on red or whatever.
Right. I mean, yeah, actually, we should probably phrase it more as a relief rally. It's probably a good way to sum it up. Um,
Yeah.
I just wanted to say something real quick.
yep.
I'm an outsider looking in, and yesterday, when you start looking at the market collapsing in your portfolio at least, and the red just appearing everywhere, and then you're watching CNBC, and everything is like the world's coming to an end. It's really kind of hard for a lot of new people to say, I'm gonna sit where I'm at and hold, firm hands, or if I'm going to buy on the dip and do it, some of these guys are saying on TV, or if I should just get out because this thing could go all the way to zero. Those are the fears that start running through people's
Right,
minds,
definitely.
and I can identify with that. So, you don't know, and sometimes when you don't know what to do, it's best not to do anything. But that's where professional traders kind of read into it a little bit more. There are some differences this time around with the Fed, all the money printing and this, that, and the other, that haven't been like other markets that even guys like, Andrew, you've been around for a long time. So there's new things, but there's always more things change the more they stay the same. You do understand how to read markets, and I think that is something that you just learn through going through these times. And it's fortunate that a lot of people are getting to experience this, because I don't think there's ever been a time in our life where we've printed so much money, we've dealt with staying home, pandemics, new financial instruments and ways to invest. So,
Well, definitely, yeah. I mean, the QE and the staying at home changed a lot of things and brought new people to the market. But the one thing that stays the same is that people become very greedy, gambling. So there's a big difference between trading and gambling. But everyone, and they're lying if they haven't, anyone who's invested or traded has had big drawdowns, if not lost everything, right? That's part of the process because it's human nature. And that's why some people just will never invest in the stock market, let alone futures markets. But
let me ask you something, Andrew. How do you discern if you've got CNBC and the information?
well, I don't.
These new
I've been on
traders.
CNBC since 2007. I mean, no
Well,
joke. You won't listen
we're
to it.
talking about the listeners. If they're getting information that's really mixed, how do they cut the noise, so to speak,
Well,
to kind
anyway,
of
good
fall
question.
back on what they should do?
So the reason we started Traders Community years and years ago was twofold. One was to try and get the real information out there, and so we had a bunch of guys trading for us and stuff like that back then. So it was a good way of sharing all the information. It was a good way the different data companies like Reuters and all that were keen on giving it to us and sharing it and stuff like that. But one was to cut out the BS. So the stories would be what actually mattered to our traders, and then that build into something else, right? So originally it was Traders Community. It was more than one or two people. And then it built different, and you can see now there's still different providers, and that's our aim to build that out. So things that actually matter, you'll see is pretty what we cover in the weeklies or any news items. So that's the idea of that. Now, the real news does come in. Look, Reuters and Bloomberg will get it wrong at times, but basically that's as far as, a lot of it is in our AI too, instead of real reporters. But that's genuine, just news. It's up to us to interpret it. What happens on the CNBCs, a lot of it's just total stock jockey sort of stuff. And then they're always bearish at the bottom, bullish at the top. And it can be day to day. And they're really flogging someone that comes on. They're like the ultimate clickbaits.
Well,
As far as the
they're fair
TV.
weather friends. they're
Right.
fair,
And
they're hot when it's hot and they're cold when it's cold.
Right, so Bloomberg is much better, and I can't say I've watched Fox Business, probably never, but I hear they're a lot better too. But I mean, it's a low bar to be better than CNBC, in my opinion. Now, there are a couple of good people on that are worth watching. There's a guy in the bond pit, Santelli, I think. Is that correct? Someone Santelli. But generally, it's flogging some agenda. There are a few people on it, but that constant hype will mess up your trading. It'll make you buy things you don't want, sell things you don't. You want to have your emotion as clear as you can. That's why I'm real big on not being excited whether you win or lose, you want to be as consistent and professional as you can be in a difficult environment, because it gets hot, and you want to have the mind and weather wherewithal just to be able to strike like a cobra, right? Which I did notice Cobra Kai is going to be on Netflix again next week. My boys did point that out, but I digress. So to get through that was why we started Traders Community originally, and then I got talked into doing this. But that was the purpose, and we used to have teacher trading rooms where people would hear me trade and I'd pay for it, all that sort of stuff. And some other
what about your stay home? Your guy that stays home, he's trading.
Well, that was the other idea, right? So what we were hearing from not only traders, we wanted to trade the way we saw, and back then you'd back people and stuff. Don't do that anymore. But you'd hear so many stories. At the same time, we had NovaWave, where there was self-directed traders that wanted to understand what was going on. And way back there, a friend of mine, John Carter, he went on and stuck with that, and that's that simpler trading. He was simply stuck to a few stocks, options, and taught people how to trade that in the discipline of just purely following a system. But I think you need also to understand how you work, because it's, as you said, it's so hard to buy when everyone's selling and so hard to sell when everyone's buying. Now, so what happens in a massive bull market, buy the dip, we all know that. But at some point, you got to know why you're buying. And if you're buying with leverage, you can blow out on just these moves that happen in individual stocks. So I'm not a big stock guy. As you know, I do the odd one, and I day trade on order flow sometimes. But because you're looking for some kind of edge, and how many times have we been in the stock where it just gets ramped one way or the other, or they do a secondary or something like that? There's even more unknowns there than the market. So you want to limit your unknowns, if you will,
So would you recommend going to value cap stocks right now, or would you say...
Well, me personally,
formulate a plan.
So my plan is, I have for longer term. I like stocks that pay a dividend, stock to make money. So, and you buy them on sell-offs basically. So like Australian banks that pay good dividends. Now a lot of these things are way overpriced. So commodity companies that pay a dividend or have what Alex calls a moat, like they're the guy, right? So that would be, from Australian point of view, that would be your BHPs and your Rios. When those prices are low, it's all key if you're trading commodity stocks, and oil's the same thing. So Exxon's a good example, pays a good interest rate, and that's dividend rate, sorry. When that gets sold off, it's a good yield, it's protective. I understand a lot of people don't want to buy fossil, so there is that negative there. But something like that. So big cap. Yes, I love trading Apple because there's volume as a trader. As an investor, like anything else, you gotta buy them low, and if you miss it, you got to be prepared to say no. Because you made a great point right at the start. You said sometimes it's just better not to trade, and that's exactly right. Some of the best trades you'll ever do are the ones you never do.
Yeah. That's a really important thing, by the way, and I think it deserves just a little bit of attention because there's so much FOMO that goes on with like less experienced traders. They get a little bit too excited. They think, oh gosh, I'm going to miss out on this, or oh, I'm sitting in front of my desk, so I have to put a trade on because I may as well be making money. Of course, you're also taking risk when you just put a trade on, and if you're not managing your risk, you might hurt yourself or even blow yourself up. So I think the most important thing is just like you said. Sometimes you just don't need to trade, and other times if you're going to trade. And I can't tell you how many times when I was a less experienced trader, I did this, and how many times I catch other people doing it and really trying to talk them out of it. It's like sometimes you just have this urge to just put on a trade. Like there's just this sort of like impulsive urge. Oh, I just have to put on a trade because, for whatever reason, I feel inspired to participate in the market. But if risk and reward are not favorable, if you don't have a plan and you just impulsively FOMO into a trade, well, what happens when it goes against you? You don't have any idea. Then you're going to respond with impulse and emotion, just like what got one into that trade. And that's exactly the wrong way to trade. And I know I'm speaking to the choir here, but I mean, I see this all the time out there. So for anyone who's listening to this, if you can't write down a plan as to why you're getting into a trade and quantify when you get out because too much risk has been experienced, or when you get out because it's reaching a price threshold, or it's appreciated enough that it's maybe showing that now its trend is getting exhausted, or whatever mechanism you use to get in or out, make sure you're qualifying that consistently. And if I might take it a step farther, if you really want to up your game, and especially if you're not very experienced, keep a trade journal. Write down every trade you're doing, why you're doing it, how it worked out, and really kind of map that out so that over time you have a sense as to whether you're making progress and where the areas of weakness that need attention are.
Oh, that's a massive thing. To this day, I still have a little trade book. I write down my trades, even though they're sitting on an electronic blotter, and I write, because firstly it gives you the discipline to clear your mind and you have a plan. But what it also does is it makes you actually focus and look at what you did, because you will learn something. This market constantly evolves. Did we think 10 years ago we would be having these massive QEs and these bubbles that go on and are over in a day? I mean, well, not literally, but that COVID sell-off was what, 3 or 4 days? It was a week of just total fear. And so,
yeah,
it hit some technical levels and all that, but really, who really held down there unless you had to, or it would happen. So what happened so fast and so quickly, it was like a deer in the headlights for a lot of investors, and they were lucky. So yes, people like to criticize the Fed for bailing the country, and really they bailed the world out. If they didn't take that action, just think what would have happened. But the big thing is, and Bernanke, when he made a big point about what he watches is consumer sentiment, and the big thing is the middle class. So who actually trades stocks? Not many. People with money, but the big unknown is a 401k guy. So he might be trading, but his stocks are going in there, right? So Apple's obviously the one for Americans. BP's one for English. Australia's going to be like BHP, Commonwealth Bank. So it's important. They worked out, okay, if we keep that going, that gets rid of a lot of that fear that went out of the way. And then we've since had self-directed traders, people staying at home. But what gets people wrong is they get too emotional. And so the whole Reddit thing, I frankly, I just can't believe it. I know some of it's true, the apes and all that. That's like the worst thing. That's ego, fun and games.
Yeah.
As far as habits go, it's not. There's nothing brave about holding something 50% against you when you have the tools that perhaps you could have done that better. Now, the other thing is expect to get whacked. Like something just from out of, you own a stock. We've probably all had it. An FDA thing happens or a market crash. That will happen. So that's why you don't over leverage. And you just never always know, You're not God. And they actually call that a psychological problem in trading, the God complex, where you can't be wrong, right? It's the market's wrong, But very, very good point about journaling and just write however you want to do it. I mean, clear your mind. Don't sit there all the time. Meditate if you do. Jog, pray, whatever it is. I don't mean pray as in I hope this comes good. I mean clear your mind, like, meditation, that sort of praying. That sounded terrible, didn't it? Mind you, I've had a couple of those hope and pray.
I'm praying for my portfolio. Oh, God.
Yeah, and if anyone who says they haven't, I mean, that's part of it. We've all whacked, and it becomes easier in many ways, but you're always surprised, right? I mean, sometimes it's unusual,
I will say there's two things that have helped me a lot on my journey in trading besides what we just talked about, and it touches on what you just said. And the first is, not assigning emotion to P&L. Like if you're losing, you just cut your losses and move on. Doesn't matter if you're wrong or right. And the other thing is not assigning emotion to any individual position, right? Like you said, don't fall in love with the stock or don't fall in love with management. There's no loyalty in this game. You got to just go where the money is, And if it's not working in your favor, cut your losses. And if it's working in your favor, ride it until the conviction or the thesis doesn't fit anymore, right? And when you absorb those things and you just neutralize the ego component of the trading experience, that's where we start to really improve not only our daily returns if we're day trading, but also the returns over time. They become more consistent, right? You're not going to hold on to losers and like you said, pray for them to get better. And you're also going to be less tempted to cut your winners early. And so there's a whole psychology behind this. And the biggest part of it is objectivity and really tactical opportunism. And those are concepts that we can embrace. And the more that we get familiar with the sort of rhythm and the character of the instruments we're trading, and the more that we get systematic in our approach to entering and exiting positions and managing risk, the better that our experience as a trader becomes. And the less emotion we assign to it, the less it grinds us down. I know a lot of people give up at this, and the biggest reason I hear is they get burnt out. There's just too much, up and down, and they feel like they're getting manic, and they're on a roller coaster. And the way I look at it is, well, then you're either trading in positions that are too large or too volatile or both, or you're just not embracing a process, and you're getting too happy when things go up and too angry or sad when things go down. And that's the opposite way. And go ahead, mate.
Yeah, I mean, actually on that, I just want to share a friend of mine, Adam Mancini, who you might know because he's become pretty big on the Twitter world, but I've known this bloke for a number of years now and seen him really develop into a great trader. And this is kind of everything we're talking about. And he said this, and I'll say it verbatim: the better my trading got, the more boring it became. Starting off was thrilling, huge wins, huger losses. As consistency improved, it became like any other job. Boring, right? Planning, daily small setbacks, in brackets, stops, and lots of boredom waiting for setups. What most find exciting is just gambling, which is what I think we touched on the start. And I think that's just to further on to what Alex said, that's exactly it. And so you have got to work out, is it a job? Are you trading? Or are you just gambling? Now, I know if you're a part-time trader, like, I don't mean it's self-directed, like just say you've got a job and you're swing trading, then you still want to do that as best you can. I know you can't be there 100%, but perhaps then you want to get the safer trade you can, one that's affordable, not too much leverage, and use optionality if you can. I mean, trouble with options, they can get very expensive, or your stock just may not have one. The spread just moved too wide. And Alex, I think he can confirm this. I remember trying to get on just decent options on Nike and stuff over the past year. I couldn't get hit at decent levels. So don't believe everything you see out there. Remember that, Alex? It was like Nike and someone else who's big. But yeah, have that, ride it, expect to learn something every day, something will surprise you, and that's really all that keeps me in it at this point, learning something new, finding a challenge, and the challenge is yourself. At the end of the day, the challenge is yourself, how you handle it.
And I think that's actually a really good point to touch on, because it really, a lot of people get all uppity about, it's me versus the market, it's me versus the suits, and yeah, there's some element of that, but really the biggest enemy that we all confront is ourselves. That is the biggest limitation to how we can perform, because the market's going to do what the market's going to do. And the people with more money that drive the order flow, they're going to do what they're going to do too. And there's nothing that we can necessarily do, emotionally speaking, other than pulling those emotions back and being very systematic in our approach to really have an edge. And the edge we have as smaller investors or retail traders or whatever is the fact that we don't really move the market much when we get in and out of things that are liquid. So if we see a big flow and we're taking advantage of that, or we see a trend day or something like that, we can get in and out of this stuff so much easier than the big guys. So there's some tactical advantages to being small in this market.
Yeah, and you want to look for your edge. I always find it interesting when people just assume they know what the big guy's doing. If the guy's really a whale, so to speak, he has a lot of maneuvering to get out of what he does. He's not going to tell you what he's doing, because you're going to front run. I mean, that's why Tudor Jones and guys like that had to give it up, because people just front run them. So they'd almost have to do the opposite to what they needed to do. If I'm the Euro trader at Deutsche Bank back, when they were the guy, if I needed to sell a yard, I would have to push it up first, because they wanted to get the best pricing for them or their customer. So I think the same thing happens in stock markets or any market, really. I mean, look, there's some guys that just blow it out and don't care. That's your corporate dealer. But everyone's the same, no different to you. You want to, out there listening, everyone wants the best for themselves, like best execution, etc. But at the end of the day, as Alex just said, they got a lot of money. They know what they're doing. They've been around. They've survived. It's a tough game out there. So why? Does it satisfy your ego to beat them, to say you beat them once or something? Don't worry about that. Worry about yourself, and try to understand what they're doing. That's why the whole other point of Nova Wave was different. There's different parts of every indicator or trading set that actually works best, so you don't fall in love. So you don't want to fall in just one of that either, because then you'll start to misinterpret it to suit your position. Elliott Wave's a great example of that. That's probably the most misunderstood technical analysis out there, and it's a lot of work. And at one point, I'm going to try to get, because I do know, I won't mention their name now, but they're one of the best in Elliott Wave in the business, but I do know a few of those. So we'll try to get them on at some point. But the point being, have a plan that you can write down, that you understand why you're buying I said the other day, comparing it to sport, know your defense. A good football team, be it rugby, US football or soccer, it's all about defense, right? Apparently the NHL don't have any defense for a few weeks, but serious. So if you get that right, the rest will follow. So you get in, you write it down, and you'll find what works and what suits your personality and your vocation. If you're full-time, short-time, investing, just everything's a little bit different. And it's an art, not a science, right? So what's good for me mightn't be good for Alex, mightn't be good for Johnny here, but there's bits of each that you can share all the time. It's not like new minds are great. Like it's very interesting, exciting to me hear what's going on in crypto, because I got to say, I'm not honest, I wasn't a believer, right? And I got to say, I still am, right? But in some of it I believe, I just don't believe in it all. I'm not in the Elon Musk camp just quite yet.
Oh, mate, you don't have $1 million of Dogecoin stashed away somewhere? I'm so disappointed.
Well, the one thing you have to understand, guys, is that it's Web 3.0. It's what we're going to, just like we went to the internet to do business. Brick and mortar is being left behind. And then now it's evolving. We are humans. We evolve. So you had first phones, and then these phones, all of a sudden you could text, and then you could text, and all of a sudden we got cameras, and everybody started using their cameras, and then we have video, and we can start doing videos, and then we can see each other and communicate. It's a natural progression. So when you have that natural progression, something more immersive is going to evolve. And whether it's VR or AR, whatever it might be, all that is going to become something that we want more interaction with, more enhanced interaction. So you keep it on its very simple, not overthinking what's happening, it's just going to be a way for us to enhance the way we conduct our business, our interests, our recreation, and things of that nature. And remember that now it's very early on in adoption. Facebook spent $7 billion, 7 years going into what they're now putting up as their new name and what their new whole goal is. It kind of reminds me of what's that? Yeah,
I think Facebook is more about redirecting the narrative to all the naughty things they've done, right?
Right. Yeah. That's a good point. But here's the thing. I've watched him in quite a few interviews. It really does make sense that he's kind of wanting to go and evolve with the social thing, but whether he's done the wrong thing with information or not, it does make sense with the vision that he has. So the thing that I like is that he's really looking at, haptics and things which, that's a sense of being able to feel stuff. And I mean, we're going to evolve to have all kinds of different things. And the big retail and investment institutions, and they see a monetary future and an opportunity in this, because just like with cell phones, there's all the different parts and things that go into a cell phone, and then all the ways that the apps that became available for these new
Right. I mean,
5G.
so it's something that it's a good point that we didn't think of any of this 10 years ago. I mean, 20 years, whenever it evolves. So who's to say there's not something that we're not even thinking of, right? That's often what happens too. So that's the beautiful thing with markets. I'm sure it'll all evolve. Remember when MySpace was a thing? I know Rupert Murdoch does. It cost him $1 billion. But so things change all the time, which makes it exciting, and that's what markets are. So that same things and if you keep that freshness about you, it doesn't mean you have to trade them, but that freshness will keep you, even if you just trade the same thing, S&P, God, how long we traded that, or oil. Things change all the time, and you may miss if you become too addicted. Look, I've seen so many people, old oil and natural gas traders, just get it so wrong, and they won't change. But if you look at other markets evolving, well, your existing market's going to evolve very similar, because those same players that are trading Bitcoin are now also trading oil or S&P or whatever. But so everything evolves, and evolve's a good word for it, and the players evolve. When you see people making fun of the Robin Hood trader or of the big guy in a hedge fund, that's your market. And you really don't know what they do, but the fact you got to make fun of someone, you can make fun of Boris Johnson's hair, but just worry about yourself, because that to me means you've got to kind of be strong of character to be successful in trading, unless you're lucky. Well, you're just a total gambler, but gamblers at the end of the day, what happens to them, right? There's a reason casinos are massive and Las Vegas exists.
Right. And I'll tell you, if you have this huge, like every institution, Morgan's, JP Morgan, I mean, everybody is getting into some aspect of the metaverse, making statements about it. And the real reason is there's in-game, which, the gaming world is huge. There's different ways to not only participate, but there's also ways that you can monetize. There's assets that you can own in the metaverse. So these new companies that are going to be coming out
a long way from
in Wall Street, but what's happening is the real value they're seeing in the metaverse is the property that you can buy and own, because once these virtual reality and these headsets and things that these kids and probably adults too are going to buy and wear, they're going to be able to participate in gatherings and things, and get invited to things from people they've never met, but then become their community. And it's an extension of themselves. But at the same time, there's unlimited possibilities. And you have to be open to what those things are. They're all coming towards us, just like things that we never thought would come towards us 20 years ago. If you see the big money going into it and getting behind it, there's a reason for it. And right now, I think there was a land purchase that was made. It was $6 million to buy a piece of land in a metaverse.
Yeah.
So, and these companies they're gonna start going public in the equities markets, and these companies are going to be basically holders of property on the metaverse.
Right. So all of what you just said, any of us that saw 2008, that's classic. What I saw their valuation. At the end of the day, rubber meets the road. I mean, I think some of it will work, but some of it, to me, and correct me if I'm wrong, just is either fanciful of someone of these kids, just fanciful, Great way to launder money, no doubt, though. So the cartel's just down the road, so I might see if they're in the middle. But seriously, we all know that with the NFT, etc. But we did get off track a little bit there. But as far as those possibilities, I think that's worth a whole separate topic or separate discussion, really, because I'm not well versed in it. I'm very skeptical of it, so I'd like to hear more on it. But let's, before we finish up, let's look at what we got ahead. We've been through the charts. Let's see what else can happen. So tomorrow in America, we do start to get a bit of data for the week. Have we had any data this week? What have we had? Nothing really, have we? So tomorrow we get the Conference Board's Consumer Confidence Index. That's going to be for December. Remember when, was it 3 months ago, we had the biggest drop in consumer confidence in 10 or 20 years. I can't remember exactly, but that's a big number coming out tomorrow. We also have existing home sales tomorrow. That's going to be a big number as well. We have the third estimate for Q3, got QE on my brain, GDP. And with that, you'll have the Fed's, used to be one of their favourite measures of inflation. It is a quarterly number, though. And we also have the weekly mortgage applications number. So people look at that, particularly when they come out the same day as a monthly home sales. So those are out tomorrow. I don't see in front of me any Fed guys talking tomorrow. There could be some that pop up. So we've also, what else we have? Oh, of course, the EIA number for oil. I gave you the API number earlier. If you're trading natty, this is that time of year. Be careful. You're going to get weather runs come out 3 times a day. So if you're a novice to it, be wary. That's about the size of it. Anything else, guys?
Yeah, so I just want to make sure that anyone who's listening, if you're trading, please be cognizant that this is a holiday shortened week, that things could be much more illiquid and volatile than normal, that if you see technical patterns, you might not be able to rely on them with the same amount of conviction that you might during a more liquid week, because things can get exaggerated both to the down and upside. So, not advice for trading, just how I handle it: smaller position sizing, less risk, less duration of risk taken. That's how I play these kinds of times. I still like to trade through some of them. I haven't completely stopped trading, but I'm not trading quite as much as I was. And I think that for a lot of us, that's kind of the way that it makes sense to handle if you're still in the office, if you're still trading. And so, we're going to have plenty of opportunities. I know a lot of folks out there, are getting into trading recently and saying, oh gosh, I really want to learn more. I want to be doing more. There's, like we were talking about earlier, you don't need to force a trade. So if you don't see an opportunity that works in your favor, be careful about, FOMO and just kind of, sit on your hands. A lot of traders fail because they blow themselves up over things like that, being emotional. So if I can imbue any knowledge upon the audience, I would say, from my own experience and the experience of other traders when they're cutting their teeth in this, be patient with yourself. Always treat yourself well, whether you're up or down, and make sure that you get into good disciplined habits. Discipline means so much when you're trading. And if you're not disciplined, you're going to get in trouble. So wishing everyone the best of luck. Happy holidays. Merry Christmas, Happy New Year to everyone that's listening. We'll be back, but I know that some people are taking off, so I just want to send my best wishes out there.
Yeah, thanks for that, Alex. And just further on that thinness, all I'm looking at is pretty well deep market. So it's pretty well just the S&P, oil, and the only stock I'm really trading is Apple, to be honest. So I want to minimize my hits, because we have positions, so you have a look at the market, but I'm pretty well out of any equity or anything. I got out of them a while back. I sold all my trash a while ago. So all that should be done. If you're American, remember you have got 10 days left till the end of the year. So be prepared for your tax situation. If it involves stocks, I'm not giving you tax advice. I'm just saying if you got things you need to sell, right? And if you're in the options and straddles situation, talk to your accountant. Pretty well that's it. So enjoy it. Take it easy. And the best thing, if you are new to trading, get that book. Just find a textbook. Don't do it on an electronic device. Take the actual physical action of using a pen and paper. It slows you down and you remember it much better. There's a lot to say about that. And take as much in from different people as you can, and you'll find someone that identifies with you, your personality, your situation, and everyone's different, and every market's different. In fact, that's something years ago I did a lecture on about different personalities of markets, but also different personalities of trading. It's like finding a partner in life, right? It's almost like that. You think I'm going to marry this one. Stocks can be like that, and markets can be like that. Like, I don't trade the Russell futures, never have, probably never will. Doesn't suit me, right? And other people love it, and then they don't like the S&P or whatever, the currencies, whatever. Well, thanks.
I will say
Sorry,
all the equity indices, the Russell is my least favorite to trade, and the SPOOs are my most. But there are sometimes times where I think I see better opportunity in the Russell, and admittedly, sometimes I'm wrong. But hey, thanks for everyone tuning in. Please please subscribe to this YouTube channel. Follow TradersCom on Twitter. Andrew's always putting out great content on the regular, and I really recommend following if you're trying to learn more about trading or just really more about what's going on in the markets. And until next time.
Yeah, likewise, and make sure you follow Markets 4, the number 4 Mayhem. Alex does great stuff. We've known each other for a long time, and Johnny's going to come out. I've known Johnny for, how long have I known you, John? 20, 30 years?
Yeah.
It's aging us. How about we go with 10 or 5 years?
Yeah.
But
5 months.
last week. But he's going to come out more and more with different technology to do with the cryptoverse.
But one thing I really do recommend is for anybody. I really recommend for anybody out there though to go and look at the report that they come out with. I just got through reading it. It gives the outlook, just like we talked about. Everybody's planning for what's going to happen in 2022. Predictions, but these guys know what's happening because of regulations and different things. We are going to not at this point talk about any of that, but we want to make sure we're mindful, just like trading, of all the things that will make us successful.
Yep, get all your ducks in a row, so to speak.
Yeah, and have a plan.
Likewise, so if we don't speak to you again, we should be around. But have a Merry Christmas, Happy Holidays, Happy New Year. If you're going to a Christmas party, get a designated driver. And we will see everyone tomorrow morning if you're still around. Thank you, good night, and thanks for joining us.